All right. Hopefully everybody can hear me. Dr. Crosby, can you hear me?
Yeah, it's Quincy. Yeah, I can hear you very well. Thank you.
It's hard for me just to say Quincy. I mean, with your past, your history, your expertise.
Well, I'm mom to a lot of people, so you can call me Quincy.
That's probably the best of all the jobs. So maybe I will, but it probably wouldn't be good. Anyway,
No,
I'm just, before we get into the heart of everything, as we're still getting a number of participants joining in, and as Thomas is, kind of flipping back and forth through the screens, being from the Midwest, and I know, Dr. Crosby, you were also from the Midwest, I think Minneapolis at some point. We tend to be more on the friendly family side, is how I like to say it.
Mm-hmm. Yeah.
So I know you're from our home office. I think you're based out of the Fort Mill, South Carolina. I'm just curious, any of your family, friends, colleagues this past week experience any problems with Hurricane Ian?
Yeah, no, actually, family that lives they live in Illinois, they're in their house in Florida near Fort Myers, and their place got battered. Now they're fine because they actually managed to get the last plane out and head to O'Hare, but they're fine. I mean, they feel lucky. They do have insurance, but as you know, obviously, I mean, the disaster is just it's dreadful. They also, by the way, they have other family that has been houses totally destroyed, and those are family that live in Florida full time. They don't go back and forth, so that they're taking up a collection for those family members.
Yeah, that's great. And I know we've tried as our office looking for things to help with. And, I've always said through the years, I think I'd rather go through a hurricane than experience some of the tornadoes. I think I'm changing that because we can build shelters. You tend to have more planning, and it usually comes in and moves out. When you have sustained winds of 150 for hours upon hours, it's just like a constant tornado. And I just can't imagine living through that.
Yeah.
It's great. Well, Thomas, I will let you go ahead and flip it. We're going to get started. So I'll let you, get us back to the main screen. For time's sake, I'm just going to jump in and we can get started. So first off, out of respect to compliance, I want to make everybody aware that this is being recorded. We are going to post this that you'll receive information on post. Give us a day or two and we'll get that added to our website. Additionally, we're going to be sending out a survey. We've had a great amount of people sign up and want to be a part. We've also had a similar amount who not able to attend but wants to listen to this. So we're going to send a survey out. Please be honest. As long as it's not about how I look today, that would be it. Everything else is feel free. So again, I'm Don Clark. I'm managing principal of Personal Financial Group. And for me to sit here and say anything other than I am not thrilled, I'm extremely thrilled, honored to be sitting, I guess, across in modern day, sitting across via internet with Dr. Quincy Krosby. When we joined LPL, it's been over 14 years ago. I went to LPL for the reason of their expanded network of the people that they surround themselves with. And I learned many years ago, I don't have to be the smartest person in the room. I just got to surround myself with very highly intelligent people. And I'm fortunate today to say I'm having that opportunity. So without further ado, I want to introduce you to LPL's Chief Global Strategist of LPL Research, Dr. Quincy Krosby. Dr. Krosby, welcome and thank you for joining today.
Thank you. I can't thank you enough for inviting me. We've done so many road shows in your neck of the woods over the years. It's a almost felt like home, coming back this way remotely. I appreciate it, and thank you all for coming on and joining us. This is a difficult time, and you always want to be optimistic. You want to be able to present the pluses and the minuses of what's going on. But sometimes when there's uncertainty, it's more difficult. The only thing that I can say is that we always get through this. So, I come from the side of the industry, which is what you think of as Wall Street, a trading floor. And I was there on 9/11. And you want to know what uncertainty is? That's uncertainty. You look at it, we looked at it, we felt it, we saw, we didn't know when markets were going to open up again. We got through it. And that, to me, was the most uncertain time of my career in this industry. We'll get through this. What's difficult now in the market, is how far is the Fed going to go? What we know is they started late. They've actually admitted it. They use this word transitory for inflation for so long that I wound up looking up the definition of transitory. Well, how long can you say transitory? Clearly, it wasn't transitory. And you expect this whole group of very smart PhDs to kind of get it, but they do their job as best they can. But they admit it, they got it wrong. Then, as they started, I'm sorry, yeah.
Oh, go ahead. I'm not going to interrupt.
No, interrupt. I want that.
Okay, I wanted to do something real quick because you're heading down a great path, and I want everyone else to. There's a couple highlights, and I know you don't like to talk about it, and it's something that's very meaningful to me. Is from a small hometown Kansas boy, grew up, dad, working the farm, throwing hay and doing things like that. I always wanted to go to Wall Street. So when I did, it was my first few years in the business, and having that opportunity to stand out by the running bull, and getting my picture with it, and attending, the New York Stock Exchange. If you would do me a favor, take a minute and talk about, again, your history. I know you started at New York Stock Exchange many, many years ago, I think as a trader or on the trading floor. Talk about that all the way to the point of not only to how you got to LPL, but maybe a minute or two as far as on the International Monetary Fund. I did a lot of research when I was working on my master's in business. I did a lot of studies, so I think it's very impactful in today's time. I mean, the role that they do play, and also just a little bit about how you were, as far as a diplomat, for the U.S. You've been confirmed by the U.S. Senate and some of those things. So just give me a couple minutes if you don't mind, and please share with the group.
Well, it's so many years. I'll take up so much time, but I believed in serving. I had gone to school overseas. I had grown up partially overseas, and what you do, you meet diplomats, you meet those who were serving, and I felt it was important to serve. So I did. One of the positions I had, I worked behind the Iron Curtain. Remember, I don't know if folks remember what that is. It's that curtain of between us and the Soviet Union. And then I also worked in London, went to school in London, worked in London at our embassy in London as the U.S. Energy Attaché in London. And OPEC, which is very timely now, was part of my portfolio, but from the perspective of the Iranians, who some of them were in London, and many obviously the North Sea oil, but energy. And then I speaking of energy, there was Mosbacher, who ran the fundraising for President George Bush, the dad, was coming to London a lot. And he's from the Mosbacher family, they're in energy. And he always wanted to come and see me as the energy attaché. And you can't be Democrat or Republican when you're serving, you just not allowed. So he actually then became the head of the Commerce Department, and under George Bush, the dad, George Herbert Walker Bush. And he then said, Quincy, would you want to come back to the States and work in the Commerce Department as an assistant secretary? And I said, yes, sir, I will do that. And that, it always takes a long time. And so I did. Then that led me to the International Monetary Fund. I was one of the 2 US representatives to the board of the IMF. And that was my last diplomatic assignment before I came to Wall Street. So this is the interesting part. When you represent your country at the board, you're looking at it from the perspective of the budget that you are the shareholder. The US is the largest shareholder of the IMF, and then looking at programs that not benefit the US, but are in conjunction with our values, in conjunction with how we see the world. And so there'd be such crazy ideas coming up. I won't even go into it, it would take too long. Crazy idea, and you have to, and diplomatically, you have to say why the US would not be voting for these crazy ideas. And by the way, so you would be in the office and you'd be lobbied. You'd be lobbied by the members who represent other countries, and they want these programs to go through. They would then go and lobby the Treasury Department. Some of them would lobby the White House, and then you would get a call. And the call would be, regardless of how you feel, you guys in the US office, you got to vote for this. And you're like, what did you just say? And you got to do what you have to do. Most of the times we prevailed. We would say, no, it's not a good idea, and so on. But it was a really interesting assignment. And just getting to the point of the IMF, International Monetary Fund, what are they doing now? Because of these interest rate hikes, the US dollar has risen dramatically. And it has a lot of pressure on emerging markets. And that's really the job of the IMF. They'll talk about the US deficit and so on, and they'll talk about Japan and China, but they really focus on the emerging markets. And this hurts them when rates are rising the way they are, and the dollar is rising along with it. It puts pressure on emerging markets. Why? They have dollar denominated debt, their country debt, sovereign debt, also corporate debt in dollars, US dollars. Well, when the dollar is stronger, it's harder to service that debt. Then they pay more for imports of oil because it's priced in US dollars. In addition to that, other food stuff that they need priced in US dollars. They're also exporters. And then when the dollar is strong, if it's commodities they export, it's harder for them. And overall, the US dollar is involved in global transactions, more that you can even imagine if you've never been in industry. So it creates difficulties all around the world. So that's the issue now. And so what I know that the IMF is doing right now is it is working with those nations, the weakest, to withstand what's going on at this point. So they have their people going on, they come up with programs for them, lending opportunities that they could borrow at a very low rate, including actually, money that goes to them directly. So that's what they do. I should point out that the World Bank and IMF went through a period where their mandate was questionable. Like, what do? They're institutions that come from the Second World War, the creation of institutions. And they went through a period of, what do we do? What's our value? And therefore their mandates have changed over the years. They've kind of broadened it out. So in any case, that was my last diplomatic assignment. And then we moved to out of Washington, we moved to Connecticut, and I went to Wall Street. So how smart was I? Well, I'll tell you what, I earned less in my first job than I did in government. You go to Wall Street, you want to earn more money, right? I wasn't embarrassed to say that. I got paid less, not just 1 year, but 2 years. And then the experience that I garnered working for the best traders I've ever worked for. And this was the day, by the way, when they had traders. Now, a lot of it is algorithms, right? High frequency trading. The New York Stock Exchange, people joke that it's a TV studio. So I worked for the real traders, the guys that you see in movies, and they were rough, they were tumbled, but they were wonderful mentors. And I worked for them. And then ultimately, one of my clients hired me to be a very junior portfolio manager on an international institutional, meaning not retail, not into Mr. and Mrs. Smith, but like pension funds globally, to go there and be an analyst and also a junior portfolio manager. And what reason I chose that was they said, and this is before, obviously long before COVID and working from home and so on, having computers and Zoom and so on. They said, Quincy, you could work from home Monday and Friday. And that was it. Because folks, I lived on a small farm way up north in Connecticut, close to the Massachusetts border. I used to leave my house at 2 o'clock in the morning, if you can imagine. And when they said that, I said, I'm in. And I was going to earn less money, much less money initially than I did on the Wall Street side. And then Deutsche Bank bought us. And that changed my life because they gave out pink slips to just about everybody. And one day they said, Quincy, you go around with the guys from Frankfurt, from London and New York, and just see what they want. Leave us alone. And at the last dinner, I thought it was just the wine talking. At the last dinner, I said, Quincy, what are your plans? And I'm kind of like, we've got 5 kids getting ready to go to college. What are my plans? I'm ready to go wait on tables. And they said, we've been talking about what are you going to do? And they offered me the job of global investment strategist for the asset management arm. So I was very fortunate. And that got me to doing the kind of work I'm doing now. So here I am. And the LPL, why LPL? So, you know, LPL has been one of our biggest clients from Prudential. LPL is the biggest client. And I did so many events where you are with, I won't mention her name, who was the host, the salesperson there, and all over the country. And then when we moved from Connecticut to Virginia, and I was supposed to go back to Wall Street, but I couldn't because we moved here. And I got a call from my friends at LPL. They said, Quincy, what would you think? What would you think of joining us? And I said, why? And the answer was, why not? And that changed it. And here I am. And yeah, so I'm very, very happy. They're good people. It's a great company. They're always, how do I say this? Everything is focused on your advisor and your clients.
Yeah.
And that is and it makes life easy. I don't have to think about what is my job. My job is working with you and your clients in any capacity, going out there, doing client events, as I think many of you know that I do a lot of, especially before COVID, and this through Zoom and so on. So that's it. And it makes life easier. And I feel like I'm at home. So many I think many advisors think I've been working here all the time because they know me from the meetings, right? Yeah. So that's my story. I'm sticking to it.
Thank you. Great information. I really appreciate it. There's several gems that's going to lead me into, I've got a series of 3 or 4 different topics that we'll try to cover. And, you know, I'm going to put you on the spot a little bit on a few of these, but
that's okay. Yeah.
I'm just going to take it. I mean, we know, like you mentioned, with the emerging markets, and it's basically because interest rates are going up, the dollar strengthening, it's hurting a lot of foreign, you know, the emerging markets, and we see that. So the big question that I have, and I get this question asked almost daily, I'll give you my quick opinion of it, and then we'll go into it. Obviously, inflation is out of control, and we have to get that under control. And I think the Fed is working diligently to do that. But the big question is, are we in a recession? And the question is, that the answer to me is, personally, I feel like people are living as if we are in a recession right now. And I think because of that, I think we are in that stage of a recession. So that's kind of my 2 cents. What are your thoughts? Are we in a recession, inflation? Talk about those 2 topics.
Okay, so this is difficult. Look, you see recession every time you read the paper, every time you're online, recession. We had 2 quarters. So remember, January, February, March, April, May, June of negative growth, so no growth. That's the definition of a recession. However, the National Bureau of Economic Research, the NBER, it's made up of the finest PhDs in the country. They meet regularly. And for many of us in the industry, they determine when we go into a recession and when we come out. Here's the problem, though. The problem is it takes them about a year to make this decision. And when you find out about it, we're out of the recession. And we're kind of like laughing. Thank you, PhDs, for telling us what we already knew. We're doing great now. This is what they look at, and this is the industry standard. So forgive me, I know about the 2 quarters, of course we do, but and the explanation for that was, well, it's an inventory recession. That's what it is. That's why it's down. It's about inventories. What they look for is, above all else, the labor market, that the unemployment rate rises and we lose jobs. And not just for one day or 1 week. They look for it has to be like maybe 2 months, even 3 months, because they look for the labor market to crater, essentially. And then when that happens, something else happens. It's almost automatic. Consumer spending starts to crater too. Because after all, your view is, oh my gosh, look at the unemployment rate, it's skyrocketing. I could be next. I don't want to spend. And remember, when we stop spending, you're looking at the economy. 70% of our economy comes from consumer spending. We're still spending. And by the way, the labor market is still pretty strong. And then they look for personal income to come down and come down markedly. Again, they want to see a pattern of it before they declare a recession. I can tell you that right now, just today, with the data that have just come out, the expectations for the 3rd quarter, so it would be January, February, March, April, May, June, July, August, September, is for actually the GDP about 2.6%, 2.7%. There will be more data releases that are just about the September that will factor in. But nonetheless, the economy is actually solid. And yet you're right. Everyone's talking about a recession. So since we are doing that, I'll get into it a little bit more. Right now, the biggest worry for the stock market is whether or not we head into a recession. And typical of people in our industry, it is, what kind of recession? Is it a earnings recession? Is it a growth recession? Or is it a kind of normal recession, but a shallow one? Or is it going to be much deeper? Until this is sorted out, it just creates confusion and uncertainty in the market. So all of the market, to me, maybe, I don't know if you feel this way, I always liken it to a GPS. You know, take in all of the information, calculate, recalculate. And that's what the market's job is, to find the valuation, or in layman's terms, how expensive, what's the price on the market, let's say on the whole S&P 500. And you only get to that, by taking as much information as possible. So what will be extremely important is the earnings season that will start in earnest in a couple of weeks.
Right.
We will hear what companies have to say. Are they firing people? Because, you know, they'll tell you right up front, oh, yeah, we're cutting costs. Well, everybody knows what that means.
Sure.
And then we'll get a sense of it. So there's an old joke, you know, I worked in New York, so the New Yorkers have a great sense of humor in a kind of dark way. But this is the joke. It's not a recession when your neighbor gets fired. It's a recession when you get fired.
Yeah. Right. I've heard, and it is so true. You know, one of the questions that I've seen, you know, in our Slido, that a couple of them that relate to this, is, are we going to see a bigger correction than what we've seen? I mean, by definition, we've reached, you know, a correction mode where we hit the 20% this last month. I mean, it seems like the last couple of days we've recovered from it. Today, actually, you know, pretty flat. It dropped and ended up started to come back up, which is usually a good sign that we didn't just get back what we burned the last 2 days. So for me, that feels like the volatility index is declining a little bit. So to me, it feels like things are calming down, I'm hoping. But what's your sense? Do you think we'll see a further correction than what we've seen to this point?
I think so much is going to depend on earnings, because if earnings and guidance, we want to hear what companies are seeing, what are their customers saying. That's going to matter. I mean, you remember what happened that Friday with FedEx? came out and said, well, they have their own problems, right? They've got their own issues that they have to deal with, but it was a broader comment from FedEx that there's a global downturn, there's a global recession coming. We need to get more information to let us know if that's going to happen, because if that does happen, the market statistically, historically does go down more. It does, it goes down more. And again, it depends on what kind of recession. If the market thinks we're going into a deeper recession, it may have to go down to 3,400, 3,500 on the S&P 500.
Right.
It's the way it is. What's happening is it's the market getting rid of all of the liquidity that was pushed in there for 10 years by the Federal Reserve, in essence, the free money. And it's getting rid of that because at the same time, the Fed is also tightening its balance sheet. So, the Fed has a balance sheet, and in the beginning of COVID, it started to buy more treasury bonds to bring the rates down. It started to buy corporate mortgage-backed securities. It boosted its balance sheet to almost $9 trillion. Now, $95 billion a month will be wound off of the balance sheet, mortgage-backed securities, and it's a form of tightening. So not only is the Fed tightening by raising rates, they're tightening by doing that. We'll see how it works out, because they had an issue with it in September of 2019 with it's called the overnight market, the repo market, folks. It just fell apart. The Fed had to go in and fix it. So
well, let's talk real quick on interest rates, because one of the big movers in the market the last couple of days was the idea that maybe the Feds, they don't need to raise a whole bunch more. Maybe they can, instead of 75 on the next one, knock it down to 50. How far do you think the Fed will go? And what's your thoughts of how far they should go?
Well, they don't want to, you've heard, how do I say this? With Jackson Hole, this was the meeting in August, folks, where all the central bank speakers come in. There was a new Federal Reserve chair, so to speak, Jerome Powell, right? Suddenly, he is Mr. Tough Guy. In 10 minutes, the market sold off about 1,000 points. Mr. Tough Guy. And he was like Paul Volcker, like, you know what? We're not stopping until this is done. So they don't want to stop and pause, because one of the things from history is, I won't mention the chairman, the Fed chairman then, but it was under Jimmy Carter, who raised rates and then waited, because rate hikes and rate cuts take time. Besides mortgages, besides credit cards, it take time to work their way into the broader economy. And so that gentleman, head of the Fed back under Jimmy Carter, waited. But unfortunately, what happened was stagflation took hold, and it was very difficult to break the stagflationary backdrop. Powell had mentioned, he didn't mention his name, but he said, we're not doing that. We're not going to pause. We're going to keep going. So now there's something in our industry. We call it the Fed funds futures market. All it is all of the investors, traders go in and they say where they think it's going to go and when it's going to end. And by the way, right now, it looks like that view is that March of 2023 will be the end. Also, you've got the tips. I think everybody knows what the Treasury inflation protection, right? The tips market is showing. That's showing that we're getting awfully close to finishing up, by the way. And yesterday, I don't know where it is right now, but yesterday, the 2-year Treasury yield, everybody knows the 10-year, because everything in the world is set on our 10-year Treasury. The 10-year Treasury yield came down, which was good. The 2-year, no, people don't talk about that because it's kind of geeky, it's geeky. But what that 2-year Treasury yield does is it is closest in the Treasury yield curve of where it thinks the Fed is going to be. It's the one that is most vulnerable to what the Fed is doing. Or I wouldn't use the word vulnerable, but closest to what the Fed is doing. That yesterday and the day before came down below 4%, which was good news, because what that was suggesting is that the Treasury market thinks, hey, the Fed is getting there. The fact is inflation is coming down. It is coming down. I could go over all the good parts of where it's coming down. The Fed has a checklist. We know what it is because he says it over and over again. It's bringing rents down. Rents are 30% of the consumer price index, 30%. And he says it's too high. Folks are hurting because of it, and we need to bring it down. It's coming down. Rents are coming down. New York City, rents are really coming down quickly. And around the country, we're seeing rents coming down. That's one. That's his checklist. Two, he wants wages to come down. Now, it sounds un-American and mean of me to say the whole market wants wages to come down except their own. But, right, you know that.
Right.
But the Fed, because this is what they're afraid of, the more that wages go up, companies don't say, oh, gee, this is great, we'll pay more and we'll eat it. No, they don't. They pass it along. And that means higher prices. So when it becomes entrenched, it's called a wage price spiral. And the Fed is determined by hook or by crook to get that broken so that doesn't continue. I just add one thing from real life that just happened the other day. Amazon made an announcement that they were going to raise the hourly wages to $19 an hour for those workers in the warehouses and drivers. Well, do you really think Amazon is sitting there and saying, yeah, we need to be good citizens and do that? We'll just take, of course, they're going to pass it along somewhere, either through the companies on their platform. You know it, I know it, and that's how they'll pay for it. But ultimately, we, the consumer, will pay for it. That's the way it works. He wants to break that. And then, yeah, so this is it. And he wants food prices to come down, even though the Fed, by the way, folks, doesn't pay attention, supposedly, I have quotes. These are my little quotes up there, because they're supposed to look at what we call core inflation, but they do not want prices for food to keep going higher because it is hurting people. We know that lower wage earners are using their credit cards to pay for things. The Fed has mentioned this many times, and those rates are moving higher, prices are moving higher. That's their view. That's their checklist. When those three things come down, we know that the Fed is on their way to 50 and then maybe 25 basis points, a quarter of 1%.
Yeah, and in my thought, I'm sitting here thinking, if I have my crystal ball looking a year from now, in my opinion, you're going to have to see rates almost go reverse and start to decline. Yes. And one of the big attributable factors to me is housing. It's difficult for people. I mean, that, a year ago, they could buy with their money a $350,000 home. Today, that for the same money is $200,000. And at some point, it's going to price them completely out. Yes,
you're absolutely right. And that's also helpful ultimately, because here's one thing. I mean, I get asked this all the time, like kitchen table economics, my family, friends, their kids, they think that I know, and my kids don't listen to me, because in 2008, one of my sons bought, I said, don't buy it. It's the top of, he went and bought it. Okay. But because I'm only mom. But I would go ahead and buy, and even if my mortgage rate is very, very high, I know that I can change it when the rates start coming down. Take advantage of the lower price of the house. Yes, you're going to pay more each month, but pretty soon those rates are going to come down and you can redo your mortgage. Because I can tell you this, when rates start to come down and dramatically come down, those prices go back up. That's the history of the kind of the housing market.
Yep, and that's what's going to happen. I mean, even to the point, whether right or wrong, I've talked with clients who are looking, they have to get a mortgage. Don't be afraid to get a variable rate right now. Exactly. The idea of a variable rate is exactly for now. Exactly.
And then you will be able to go and you will be able, regardless who's in the White House, because then I'll get, well, what happens if the Democrats, it doesn't matter. That market works on its own and the rates will come down. Now, let me put it this way. If the market thought that there was a recession around the corner, those rates would already start coming down. There'd be what we call a growth scare in the treasury market and the yields start coming down, but they will come down. They will come down for whatever reason. They are going to come down. You know why, how I know? Because they always do.
They do. And you're exactly right. And, one of the things I learned early in my career, and you probably have heard it many a times too, the two things you don't talk about is religion and politics. Well, I'm going to
Right.
break one of those rules because it's been brought up and we all know, everybody asked me, Don, who's going to win? How's that going to affect either
Yeah.
side? Now, why I
Yeah.
say there's not a correlation, you cannot find a direct correlation. I look for correlations because it's easy, then you can hedge against it one way or the other. But
Yeah.
what are your thoughts with how the midterm elections and how are they going to affect the markets, or are they really have no impact either way?
Okay, well, it is. This is everybody's asking this. So if I may, right now, today, it looks as if the Senate is 50-50 because if you don't get Georgia, the Democrats are going to keep the Senate. And there's trouble for the Republican candidate, the
Right.
former football player. I don't know.
Yeah,
if it's gonna
yesterday
matter.
was not a good day for him. Right.
No, and they're coming out of the woodwork. It's like
Yeah.
the dam is broken. So
The October
that's
surprise.
exactly, yeah, exactly. And this was his son, actually,
His
who
son,
started
yes.
it. Yeah, Christian. So it looks as if now that the Republicans are unless something happens, on the way to winning the House. So that would mean if the Democrats win the Senate, and it's what we call gridlock. Markets kind of like gridlock. Don't think for a minute they don't. But there are some things that they can work on. And one of them has direct implications for a number of sectors. And that is, you know how on January 1st, 2022, the research and developments called the R&D tax changed. And that meant that the companies couldn't go in and claim the tax. They had to divvy it up over 5 years, which is kind of crazy because they always were able to just go in and get it 1 year, right? I want that tax break. So the expectations are, and these are expectations based on consultants who do very good jobs, that it's bipartisan. They want to fix this. And so if it is gridlock, it looks as if they will go in and fix it, which means a lot of money for these companies. You know who the biggest lobbyists are the defense contractors. They are the ones going in and saying, look, this is killing us. You want us to do more R&D, research and development, get the hypersonic missiles so that North Korea doesn't beat us in that. I mean,
Right.
I'm being facetious, but
No,
that
right.
happens to be true though. But that would be true. But in any event, they're in there. The tech companies are in there, and so are the healthcare companies. So it looks as if they will fix that, and that matters. They will get a lot more cash. We expect defense spending to pick up, even if the Democrats were to win the Senate. That defense spending will pick up. This will help it. They'll help underpin it, and will help give them more cash to this defense spending, and then healthcare names also, and the bigger industrial names are hurting on this, and I think it's going to help. So keep your eye. It's funny because the market, there's an old saying from the trading floor, and that is the market gets the news first. Keep your eye on it and see, where the market is putting money. So that's one thing. If the Democrats get a clean sweep, if they do, let's say for whatever reason they get both houses, there is a child care tax that will go through. They're pushing for it. The Democrats don't have to do it during a lame duck session. They could wait till 2023 when they know that they've got both houses. So which names do well? Anything associated, if you've got kids or grandkids, you go to Apple. I'm not endorsing these
Right.
names. I can't do that. But
Right.
they're baskets, right? Heaven forbid. I always feel like God's going to strike me down dead if I say any name of a stock. But so Apple, for obvious reasons that
Sure.
you're going to buy your kids things. Discounters, so furniture discounters, for example. Take your kids out to dinner, right? That's also part of it. And also big stores, because you're going to go food shopping more. You're going to have more money for food. Those names. It's going to be a childcare, and they will probably wait for 20. If it's split, they're not going to get it in lame duck. So that's another one that we keep our eye on. Well, here's one for everybody because it matters, and that is energy. Interestingly, and the Democrats have their own tug of war with the progressive side and the conservative side of the party, is expectations for exploration, drilling and exploration, right, and refining, because we haven't built a refiner in this country in decades.
It's been a long time.
It's been a long time. You see what's happening. You don't want the cartel. By the way, the U.S. is not involved in OPEC. We're not in OPEC plus.
Right.
Russia is very big in it. You don't want oil weaponized, right? So they're looking for more, and you don't expect it from this administration, because this is what, quote unquote, a green. These are my quotes. I always do that. Green administration. But even if you say electric 2035, the whole country, you've got to build that infrastructure. What are you going to do in between? You've got to drive your cars, you've got to drive vehicles, planes, and so on. That may go through, although the progressives are saying no. Today, President Biden announced that he was taking more oil out of the Strategic Petroleum Reserve because of the proposed cuts from OPEC. Folks, not all of OPEC countries can actually cut production. They don't even have enough supplies, even if they didn't announce that. So we're not expecting to see a major spike in gasoline prices. But there is an issue here. There is an issue here. We need more refineries. We need more oil, and we can do it. We can do it. We were energy independent. We don't want to wind up like Germany, dependent on, on Russia sending us. Russia's a major oil exporter, by the way. So
right.
Yeah.
Well, and I was going to say, the refineries, for no perfect, example than the hurricanes. A lot of our refineries are down south. We have to protect ourselves from that. So why not use this as a great opportunity?
Yeah.
And again, you can do it still with the environment in mind. We all know that. So I agree with you. I tend to agree. So let me transition just a moment. I'm trying to implement some questions that I see. People are, as we're all looking, what should we do during the volatile times? We don't know. Is the market going to sustain itself? Is it going to go up? I tend to one that believe that over time, things will work themselves out. You tend to hold unless you have, you keep your reserves, and I tend to have more reserves these days is what I recommend, at least 6 to 12 months. But where should people, for those who are wanting, to wait till the market stabilize, where's a good place to park assets in your opinion? And what should other investors do?
Well, take a look at some of these CDs. They're offering some decent rates. What we call the short end of the yield curve, we call it that. It's like the 2-year treasury, offering a nice amount of money. People are terrified of the bond market because it started off the year in horrible shape, just like the equity market. But it's been leveling off, and you could get investment grade bonds that are what we call short duration. So you're not paid out 10 years from now, with a very nice yield, good quality companies. So suddenly the bond market has become very attractive. Some of the money market funds are actually offering a decent amount where you can get a nice return. You have to shop for it, but you can do that. So you can park money there. And there are some stable value funds where they're actually upping the rate because there's been tremendous demand and as rates crawl higher. Dividend paying stocks. So I just mentioned this, I'm not just saying it in general, because LPL Research does have energy as one of our sectors that we like. The energy companies, it's fascinating. Years ago, they would spend billions and billions of dollars on exploration that never showed up, and some crazy things, paying themselves. They have been much more careful now. It's about shareholder value. It is about sweetening dividends. In fact, some of the smaller companies of the exploration and production companies, and some of the smaller refiners, are not just offering dividends, but they offer special dividends. So if there's more cash flow, they will actually pay it out to the shareholders. It's a sea change in the way they are operating in this environment. And we have to expect, because supplies are tight and that oil prices are beginning to stabilize, OPEC would like to see it at $90 a barrel. I mean, if they had their druthers, it would be $100 a barrel to
Sure, right.
defend. That ain't going to happen. You know, they know how the world is changing. In many ways, you can't blame them for wanting to raise as much money as they can before things really do change. But nonetheless, the energy market, natural gas, oil, giving back to the shareholder, and you could do very well. So dividends still are important. People say they're not as important because now you've got interest rates rising. But nonetheless, you could have capital appreciation coupled with attractive dividends.
Right. Having a little bit of an experience in the oil industry with family and things, I know at $90 oil barrel, $90 per barrel, it's very profitable, and it's plenty of money to do further exploration as well as take care of shareholders. 90 is very optimal, and they can do it for far less, but 90 is a good number.
Well, exactly. Buffett is buying what? Occidental Petroleum. They need about $40 to make money. 40.
I was gonna say 45 is what I always
exactly. Exactly.
You're right.
Exactly. Yeah.
So I've got a quick funny story, and then I'm going to kind of transition to the close as we're coming up on 48 minutes here. I always laugh. You mentioned CDs, and when I started early in this career 30 some years ago, I've been with my wife forever, and her mother, we call her Grams. Graham said, Don, I'm going to allow you to invest some of my money. And I said, great. I said, finally, I get this opportunity. I said, what can I do? She said, well, I have this CD coming due. She says, I just want you to get close and match it. I said, great, Grams, I'm happy to. She says, all right, this 12% CD comes due next month. How close can you get to it? Well, as we know, 12% rates haven't been since the 70s, and she had locked it in for a long, long time. I don't think we're going to see CD rates get up to that level. At least I hope not, because inflation is going to be crazy.
Yeah.
But I think you're right. And for cash assets, short-term cash assets, I think CDs make a good place, a parking place for some of those assets, but not for everything, because we're still, like you said, dividend paying stock. There's still good. There's still good investments out there that are paying good dividends and things. Yeah. So with that, I just kind of want to transition the next couple minutes. And again, a reminder to everybody, if you want to listen to parts of this again, it is being recorded and it will be posted on our website, as well as we'll send out a survey and other things here later. But I would ask you, Dr. Krosby, in closing, what pearls of wisdom would you give to not only to myself, to the client? What would you add that maybe we haven't talked about that you think is important?
Okay, nothing stays the same forever. We get caught in this and we think, oh, this is the way it's going to be. It's going to change. Things change. And may I give an example of it? Because this is real life. So the Federal Reserve, without inflation, wanted to raise rates in 2018. And why? Chairman Powell was head of the Fed then, too. He felt that low rates are dangerous because people take on more risk, and risk begets risk until something happens to just, pierce the risk bubble. He said, we've got to normalize rates. So as Fed chair, he embarked on raising rates. Remember, we weren't worried about inflation at all. He got to 3.4% on the 10-year Treasury in November of 2018. It didn't last because the market, by the way, was revolting against this. Housing prices, anything associated with the auto industry. So get to November, it crosses over 3.4%. Boy, the market just did not care for that at all. Then they get to the December meeting of the Fed in 2018, and they raise rates again. And they telegraphed that we probably have rate hikes in 2019. Well, this is what happened. It was Christmas Eve. Christmas Eve was horrible. And we were hosting Christmas Eve dinner. And I'm cooking and fixing food. And the market is tanking and tanking. I mean, like turning on a water faucet. And remember that? It was really, it was palpable. It was frightening. The only thing that was good news about it is I always remember the guys on the trading floor would say, well, when the market closes early, like on Christmas Eve, you can't lose any money. So my eyes on the clock and the stove and boiling and poaching and you name it. And I'm like, dear God, make this, because you can't lose money when the market closes. So it closes early on Christmas Eve. So when Christmas Eve comes to the table, everybody's like, Quincy, am I going to be able to retire? I mean, should I wait till the market opens and just sell everything? Because this is horrible. I'm not going to be able to retire. One person after another, terrifying everybody. I was starting to shake. And so it was Christmas Eve. And this is finally what happened. I said, open up another bottle of wine and please pass it around. Just drink the wine and just please, just keep drinking the wine and we'll be fine. So this is what happened. It's like a homily that I'm saying right now. So that's Christmas Eve. January 4th, 2019 is a Friday morning. It's actually a morning. I actually happened to be on CNBC that morning just to make those little comments that people do when the payroll numbers come out at 8:30
Sure.
Eastern. And so before that even happened, Chairman Powell was at the American Economic Association meeting, January 4th, 2019. You know what he comes out and says? I can't make this up. It's like a textbook. He says, yeah, I have an announcement. The Fed is going to be patient. That's code for the Fed is not going to raise rates.
Right.
The futures market went through the roof. All week long, the market just shot up, and it was like magic. The Fed lowered rates all of 2019. Nothing stays the same forever. We're going to get through this. The Fed may have to slow things down. Something may break, quote unquote, break. That requires the Fed to slow things down, stop quantitative tightening, and then we will get through it. And as you say, Don, the Treasury market's going to pick it up. The yields are going to come down. And here's another one. So, you know, we've been in consumer staples at LPL Research.
Right.
Watch to see that transition and go into consumer discretionary. When you start to see the rates come down, and when you start to see consumer discretionary get more investor, not trader, but investor interest, and really climb higher, like really climb higher, you know it's the market sniffing out the end. That's the way the market does it. It sniffs out. And I don't mean like one day of it. I just mean you build on it. You build on it. Everything that we have that's kind of defensive will transition into growth, including I mentioned Apple, including Apple. I'm not saying I'm buying Apple, but 7% of the S&P 500. Apple is a big portion of NASDAQ. It's a big portion of the Dow. It's a big portion. We look for those names, and I'm not saying I'm not saying we endorse that, but we look for those names to start really gaining and becoming viable again. Because those are our signals. Those are our signals.
They really are. And almost everybody who's invested in any type of large company, stock, mutual fund, ETF, or stock portfolio has Apple.
Yeah.
So just about everybody that's associated on this owns a portion of Apple, whether we know it or not. We all do. So
exactly.
It's great. So in quick,
I got one more.
I
got one more.
Okay.
Housing-related stocks. Housing-related stocks start to get a bit, because what's the market looking at? The market is psyching it and saying, hey, rates are going to come down. People are going to go back looking at houses. That's why I want to put that in there. Yeah,
and I think that's great. And there are a lot of great within that industry, great investment options that we have. I mean, even from a specified ETF or things like that. I mean, not to get into specifics, but you're right. Yeah. So just kind of in closing, I'm just kind of curious. I've never had the opportunity as of yet to join the CNBCs of the world or Bloomberg or Fox Business, any of those. So what does your family think when they see mom on TV, in the role of being doctor, a doctor providing great information? What do they think, and how do you feel about it?
Well, first of all, the media never uses doctors, so I'm not alone. I've got colleagues. Dr. Roach is our chief economist. He's doctor. In other firms, they're doctor. They never do. That's not the way it is. It's just Quincy, which is great. In the very beginning, they were like, ooh, and then then I stopped telling them when I was on, because I have sons and I have daughters. But the daughters would be like, Mom, what were you doing with that lipstick? What were you thinking with that? Now, how am I supposed to change it? It's already out there. Mom, what were you wearing that for? That doesn't look good on TV. And I'd be like, okay, that's it. They're not going to know. So sometimes I would only tell my sons, because they're like my husband, Mom, you look great. It doesn't matter what it is. It's Mom, you look great. But it just reached the point where I just like, that's it. So I'll tell you one thing that's good is and before COVID, and we lived in the Northeast, but far from New York. We lived way up in Connecticut near the Mass border, but I would go into New York and go right down to the studio, right where they were.
I wonder.
And what I loved, oh yeah, but here's the greatest part. So this is where Vanity comes in, to any ladies who are listening. So they have the people who do hair and makeup. And oh my goodness, especially Fox, they have the best. I shouldn't say especially, Bloomberg does too, and so does CNBC, but they would do your hair, they do your makeup. And suddenly you go out there and you feel like, oh, you feel so much better. But with COVID, I do my own makeup, and you can see I've been on TV. I've been on webinars all day long. I haven't had a chance to pick myself out.
You look great.
So, but the lighting is great. And no one, I hate to say it, you know this, Don, you're an advisor. In your office, I bet you anything you've got it on, but the volume is off.
Yep, you're exactly right. And it's usually 2 or 3 different channels.
Yeah, exactly. So you don't know what people are saying. You just know how they look. And so I would remember, okay, this is a great one to end. So my former bosses, the traders, great guys, salt of the earth. So they will see me and they'll text, like, don't they pay you enough? You're wearing the same outfit you wore on your first day in Wall Street. They always have something like funny to say. Like, and how'd you learn that, Quincy? We didn't teach you that. So there you go.
That's great. You're wonderful. Thank you. I appreciate We're at the top of the hour. I hope to have an opportunity someday that we can do this in person.
Oh, awesome. Awesome. We live for that. There's nothing better than the client events when you're out, sitting with folks and talking. This is better than not doing anything, but we thank you. And all I could leave you with is this: we're going to get through this. The greatest companies on the earth are here in the US, and they're on sale. And guess what? They'll probably be even more on sale by the time we're finished. That's what I'm waiting for.
Yep, me too. And I think that's great advice and great words of wisdom to leave on. So thank you, Quincy. Thank you very kindly.
Thank you.
I appreciate it. It's been wonderful. And I hope everyone picked up at least one gem. I always say if you could pick up 1, maybe 2, 3 is a real bonus. So hopefully you picked up a few items today that will help. Please submit any additional questions. I did get all the questions integrated over this past hour. So feel free to send us a direct question and I'll be happy to answer from there. So with that, we're going to sign off and thank you. God bless.
Thank you and Thomas. Bye. God bless. Bye. Bye.